Many asset protection structures fail even though a trust, foundation, or holding company exists. The issue is not the structure itself, but how the assets are owned, controlled, and governed around the structure. When ownership remains exposed or governance is unclear, claims can still reach the asset and succession can still create delays. This creates practical consequences. Control may pause during disputes. Banks may restrict access, and cross-border assets may still be treated as part of your personal estate. The structure exists, but the protection is weaker than expected. My name is Shiraz Waheed, and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain the 10 things that can weaken asset protection, where the risk typically appears, and how proper structuring help reduce these vulnerabilities. The first threat to asset protection is holding assets directly in your personal name. This is the most common structure because it is simple. You open a bank account, buy property, and hold shares personally. From an administrative perspective, this might be straightforward, but legally everything remains attached to your personal estate. If a legal claim arises, the claimant does not need to navigate multiple layers. The assets are already linked to you. Courts can identify ownership quickly, and enforcement becomes more straightforward. This is especially relevant when assets are held across multiple countries because enforcement can follow the ownership trail. On the other hand, when assets are held through a properly structured vehicle such as a foundation, trust, or holding companies, ownership is separated. Control over those assets can still remain with you, but legally ownership sits at another level. This does not eliminate risk, but it changes how claims interact with the structure and often increases complexity and enforcement. The second threat I would like to discuss is timing. Asset protection is strongest when structures are created before any dispute exists. When structures are introduced after a claim, investigation, or creditor issue appears, the intent may be questioned. Many jurisdictions apply rules around fraudulent conveyance or transactions intended to defeat creditors. If assets are transferred after risk becomes visible, courts may review the timing and intent. This can weaken the credibility of the structure. This is why asset protection is primarily a governance exercise, not a reaction. Structures built early tend to look like long-term planning. Structures built during pressure may be viewed differently. Timing does not remove risk, but it significantly affects how the structures are interpreted. The third threat is concentrating everything in one jurisdiction. Many investors create a structure but keep all assets, ownership, and control in the same country. This limits the effectiveness of layering. If the legal structure that governs you personally also governs the structure and the assets, separation becomes limited. Courts can have direct access across all elements. This reduces the practical barrier between personal exposure and asset ownership. Cross-border structuring introduces jurisdictional separation. For example, assets may sit in one country, while ownership is held through a foundation or a trust in a different regulated jurisdiction. Dubai structures such as DIFC and ADGM are often used in this context because they operate under independent legal framework. The goal is to separate ownership clearly within a regulated and transparent structure. Another threat is when a structure exists, but the rules and roles are not clearly defined. A trust, foundation, or holding company without clear documentation can become vulnerable. If decision-making is unclear or roles are not defined, the structure may be challenged. Courts and banks both look at governance. They review who control assets, how decisions are made, and whether formal processes exist. If everything operating informally, the structure may be viewed as an extension of personal ownership. Clear governance documentation, including bylaws, council rules, protector oversight, or board procedures, help demonstrate separation. This makes the structure easier for banks to accept. It also shows the structure is properly set up and not just on paper. The fifth threat is partial structuring. Some assets sit inside a structure while others remain in personal name. This creates uneven protection. If personal assets remain exposed, they can still become entry point for claims. In some cases, pressure on personal assets indirectly affects the structured assets. Banks may review relationships, counterparties may react, and control can become complicated. Asset protection works best when ownership is coordinated. This does not mean every asset must be transferred, but the overall structure should be aligned. Fragmented ownership weakens the overall framework. Another common issue is retaining full personal control without separation. If you remain sole decision maker, sole signatory, and sole beneficiary, the structure may only exist on paper. Asset protection structures usually balance control with governance. For example, foundation may include council members. Trust may include trustees, and holding companies may include board of directors. This does not remove your influence, but it introduces formal decision-making layer. If control remains entirely personal, claimant may argue that the structure does not operate independently. This can reduce the effectiveness of the structure that you have created. Proper governance allows control to exist within a framework rather than outside it. A structure that looks strong legally but does not work with banks creates practical risk. Banks review ownership layers, beneficial owners, and governance. If the structure appears unclear, accounts may be restricted or delayed. This becomes important during disputes, succession, or transfers. Even if legal ownership is structured, banking friction can slow access to assets. Asset protection is not only legal, it must also functional operationally. Jurisdictions such as DIFC and ADGM are often used because banks are familiar with their framework. These are regulated environments and with recognized legal standards. This improves acceptance and reduces operational friction, although each bank still performs its own reviews. Asset protection is also weakened when succession is not properly planned. If the structure depends entirely on one individual, continuity becomes uncertain. For example, if a founder controls a holding company without clear succession rules, control may still pass through probate. Similarly, if trustees or council members are not defined, governance may pause. Proper structures include continuity planning. Foundations allow council succession. Trust defines trustee replacement. Holding companies define board transition. This ensures control continues without interruption. Asset protection includes continuity, not only legal separation. Another threat appears when tax and residency rules are ignored. Creating a structure does not automatically change tax exposure. Domicile, residency, and asset location still matter. If a structure is created in one jurisdiction while management occurs in a different, tax authorities may review where control actually sits. This can create unexpected reporting or tax consequences. Asset protection must be coordinated with tax planning. The objective is structural clarity and not automatic tax reduction. Each jurisdiction applies its own rules and proper advice ensures alignment. The final threat is assuming that once a structure is created, it never needs review. Families move, assets change, businesses expand, and regulations evolve. A structure that worked initially may no longer fit. Periodic reviews ensures governance remains aligned. Banking relationships may change, jurisdictional rules may update, and asset composition may shift. Adjusting the structure maintains effectiveness. Asset protection is not a single transaction. It is an ongoing framework that evolves with your situation. Regular reviews helps maintain separation, governance, and operational functionality. So if you would like to work with us on asset protection and succession planning, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.